Oil futures were set for a sixth day of losses as the death toll from the virus in China rose, but the heavy sell-off of recent sessions was curbed by output outages in Libya and oil cartel Opec comments designed to calm demand fears. Brent crude was down 51 cents at $58.81 a barrel. And of course, the JSE recorded its biggest one-day fall in more than 8 months on Monday, with global markets slumping as the death toll from the coronavirus increased and amid concern that the outbreak may have an effect on the global economy. Let's have some market analysis with Ricus Reeders, who is market analyst at PSG. Thank you very much for coming.
Hi, Gordon.
Right, starting here at home and linking with the developments abroad, the impact of coronavirus in as far as oil prices are concerned, business travel, and the impact on business generally, how do you view it?
The easy answer is we're not quite sure what the longer term effect is going to be, and that depends on how broad-based the spread is going to be, how it will affect things like consuming in China with for example, people being quarantined in cities, how it will affect travel, how it will affect even things like resources. In other words, whether it's going to have a real big knock-on effect as far as global growth is concerned, or whether, like in 2002, 2003 with SARS, that effect was there for a few months, but we had a sharp recovery after that initial scare.
So is this really going to impact on the oil prices?
It could. If it really impacts on global growth, then obviously, if you're not growing, you need less energy, and the energy you are getting from oil, so that will be a direct effect to that.
Now, looking at how the South African market has been performing, the JSE experienced a knock-on effect and some losses that it actually closed lower yesterday. Given the progression and the death toll, from now, if you just take a look at the long-haul outlook of this virus and how things are going to happen on the markets, how do you think the JSE will be able to sustain its trade?
Well, as I've said, we are dependent on what happens with global markets, and if global markets go down, we cannot not follow them. It really depends on how much it will impact us, and as far as business is concerned, our main business is commodities. If there is a slowdown, obviously mines will sell less, whether it be iron ore or copper or even things like platinum. So that will have a big effect, and obviously that will also affect those industrial counters which are manufacturing for export.
And still on the JSE, I mean, it said that its group sales increased by 3.8%, and looking at how it has been performing from December onwards, the shares also took a knock at 46 Rand 15 cents after going down 3.15%. That really clearly shows how actually the market has been affected by that.
If we are talking about Woolworths, yes, if I'm not mistaken. Yes, I think one of the things that came out from the Woolworths update is how much it sells, whether it be in fashion and beauty and clothing, or on the food side, was actually affected by the power cuts we had during December. Apart from the Australian operations, which maybe sort of was a little bit better than, for example, the November update. But I think the Woolworths share price specifically had run up in anticipation of these results, or of the trading update, and it possibly just got a little bit ahead of itself.
And looking at the Pepco results, I mean, like Moody's Investor Service assigned the retailer an A3.ZA rating, which is considered a low-risk credit. What do you make out of that, since the share price fell to 0.96% at 16 Rand 56 cents?
I think a lot of the market movement we are getting in shares is tied in with the scare globally at the moment. Pepco itself, operationally, did pretty well in very bad circumstances. I think their concentration on the sort of lower spectrum of the market is serving them well. There is the unfortunate overhang of the Steinhoff business they were involved in, and I think that's possibly just putting a little bit of a break on what I thought was pretty good results otherwise.
Yesterday we were speaking to John Lewis of FNB, who is a property strategist, and we were looking at how things were on the downside in as far as the property market is concerned. Now, looking at the investment property fund, now it's ridding itself of 727 million rand stake in 2 South African malls. Is that a rubber stamp of lack of confidence in the property market? The company specifically stated that it's not a lack of confidence, but that they are looking at, in the end, what return they can get for their shareholders. So they still have a massive property portfolio locally left, but what they were doing was realizing funds out of the sale of these 2 properties to fund investment into Europe, which they see as a better growth area. So it is a business decision rather than a confidence decision. Right. Just your parting shot, when you look at some economists calling a spade about the woes of the South African economy. I mean, like, even over the weekend, we saw that interview of Bruce Whitfield speaking to Richard Quest, saying that, I mean, like, in South Africa, who do you expect to come and rescue your economy when you don't even have anybody who went to jail for corruption in this country? So do we think that we're doing things right and we expect our economy to grow?
Yes, I think the reason something like that Quest interview has such an impact is because it's an outsider commentating. It's almost like being part of a family, and the family members, our local analysts, we talk amongst ourselves and we are used to it. But when somebody comes in through the door and says, this family is not looking good, all of a sudden you have a new outside opinion and people notice it.
Do we really need to have somebody to tell us what we're doing wrong when we in fact know that we are doing wrong?
I think I agree with you completely. We know what is wrong. If somebody else tells you that, maybe it just puts a little highlight, a little line about what we know are the problems and also the ways to fix it.
All right. Well, thank you so much for making time to speak to us. So much to talk about what's happening in the market, but I guess this will be, a future throw up for the other issues that will come up during the week. But for now, let's nip it there.
Thank you.
Right. Ricus Reeders is market analyst at PSG.